Financial success doesn't happen overnight. It's a long journey to get to the top, and individuals that do share a very common thread when it comes to the financial success they see. In today's video, we're going to be breaking down 20 key principles to follow, and if you implement these 20 principles, it is almost impossible to meet. It should be almost impossible to not meet those financial goals. The first one we look at is keeping a budget. This is really the key to financial health and really having discipline to know exactly where your money is going. It is the bedrock. It is the foundational. When I start looking at financial education and counseling, it is the point that I do. It's hard to know exactly where your money is going if you don't know where it's going. When you get paid, when you pay all your bills, every dollar has a purpose. Old saying from Dave Ramsey, keeping a proper budget will keep your money in line, and you'll always be able to pinpoint if things ever go astray or expenses are out of hand, and you can make that course correction. Now, the second one that we look into is the emergency fund. There is a reason, again, when it comes to financial education, when it comes to counseling, stockpiling, or having that emergency fund roughly 3 to 6 months will be a game changer. And it is the critical buffer zone between when you have an accident or something happens and being able to recover from it financially. There is going to be a point, and some of the catalysts could be losing a job, having an illness, unexpected bill, unexpected car repair. The emergency fund is going to keep you from having to borrow money, which again is a game changer because you don't have to go into debt to cover an emergency that you had. The third one we look at, staying away from high interest debt. We are talking about credit cards. When you start looking at credit card bills, when you start getting $2, $3, even $5,000 on there, even looking at payday loans, it is an absolute 100% recipe for disaster. This kind of debt will trap you in an endless cycle of payments. Get rid of the high interest debt, get rid of those credit card bills, and save your money so you can actually save it for the emergency fund. You can actually use it to get your time back, but you can always look at the compounding power and you can start investing. Now, of course, with financial education, getting to the promised land, keeping track of your credit score. There's one side of the fence, like Dave Ramsey, that says you don't need a credit score at all. But I'm on the side, you do need a credit score, and it will impact a couple different things: loan approvals, interest rates, insurance costs. And that's some of the big things. When we start looking at the cost of insurance, when we start looking at getting a job, there are a lot of things that people use credit scores for that are not associated or not in relationship to lending. If you want to go get an apartment, even just to rent a place, chances are they're going to pull your credit score. Keeping track of that score will really keep you from and allow you to identify errors, correct them, improve your borrowing power if you need to borrow, and honestly, not borrowing at that high rate. Now, of course, when it comes to financial success, starting early for retirement, we have talked about compounding interest, where if somebody starts from the age of 20 to 30, putting the same amount into a IRA, a 401k, then you have a person that starts from 30 to 65. The person who invested for those first 10 years is going to have more money overall. Small contributions are going to build that retirement account. You want to make sure 100% that you're getting your employer match. IRAs can grow significantly when you leave them alone and have them invested properly for decades, ensuring that long-term financial stability that we need. Now, of course, one of the biggest and craziest ideas that I discuss a lot: live within your means. Again, going back to Dave Ramsey, going to the spending plan with Ramit, going to any financial education, spending less than you earn will help you build wealth, period. Could it really be more simple? Lifestyle inflation is one of the absolute biggest things that eats into your savings potential, eats into that investment potential, and that debt repayment. You have to keep your expenses under control, guys. You have to know, and there has to be room in there for savings. There has to be room in there for investing and building up that interest. And when we talk about investing, we look at diversification. Diversification is a very simple principle, but it bears repeating. Don't put all your money in one place. If something should happen, investments need to be crossed and really set across different stocks, different ETFs, and really looking at possibly bonds, assets that can mitigate your risk in a down market and make a better potential and a long-term potential for growth. This is the reason when it comes to diversification, I make sure that I do diversify, and I do it across a multitude of ETFs. If you checked out some of my videos, you know exactly what I'm talking about. Then we get into insurance. Insurance and insuring against big risk, guys. A lot of people think it's a waste of money until there's a point when you have to use it. When you look at health insurance, when you look at life insurance, disability, property insurance, Those are defenses. Those are your frontline defenses versus your financial future. Without the coverage, if you have an accident, if there's an illness, if it's extended amount of time, it could wipe out months, years, possibly even decades, depending on what it is. Make sure you have those policies in place where you're not going to be footing the entire health bill and making sure you have those coverages. Now, again, when we start thinking of planning and really investing, it is 5+ years, but let's plan ahead for those major expenses. When we start thinking about the 1 to 3 year ability and planning it out, making that financial plan, when you start thinking about savings for kids' college, let's say weddings, major home purchases or upgrades, repairs, you know what is coming. There's no reason why you have to take out a costly loan. You go to a bank, you borrow $25,000 to get a new roof. Over the next 10 years, you pay $40,000 for your new roof. Anticipating these big ticket items, having an account set aside to save this money will limit your debt and limit how much money you do have to pay when it comes to the repayment aspect. Same scenario, if you need $25,000 for a roof, I already have $15,000 saved. There's a big difference between borrowing $10,000 and borrowing $25,000 for the exact same thing because you planned ahead and you set money aside. Now, of course, financial education literacy, just like we do on this channel. If you like the video, guys, definitely subscribe to the channel. We do videos every single day. So let's go on to our next one. You need to understand how interest rates work, and really, it is a massive impact on your savings, on your debt. When you're borrowing, the higher the interest rate, the more it is going to cost you, while the higher the savings rate, the faster you're going to build your nest egg. And again, when we think about this difference, you're either on the side of the fence where you're paying a lot of interest, or you're trying to be on the side of the fence where your money is making a lot of interest, your investment account is having a lot of growth. So there are two places for this, and you have to decide logically and really financially which side you're going to be on. The more that you can mitigate the debt side, the more you have the ability to go on the investing side, which can definitely change it. And to make all of this super easy, automating your savings. This will help you build a very disciplined, very consistent approach without ever having to think about this. This is the same methodology that we see with like a 401k plan. Let's say you put 5% of your income in there. You are putting 5% automatically. You're getting whatever match that is out there. This happens automatically, goes directly into the savings account, directly into your retirement account to ensure that you pay yourself before you have access to those funds, because a lot of people will not use it. And when we start looking at that match, take advantage of your employer benefits. If you're looking at retirement matching, HSA accounts, stock options, you need to take full advantage of it. When you start looking at your total compensation package, when it comes to an employer, making the most of these perks, usually for a lot of people, are free income streams towards your financial goals. If you're buying stock options, let's say you work for Amazon, and it's at a 15% discount, which I believe that's what their program is. You're buying a company you work in that you're invested in at a discount, which is phenomenal. Making sure, again, that you're taking advantage of all those employer benefits will make a big difference. And like we talked about earlier, building out that budget, guess what? You have to review it. The budgeting is not a one-time set it and forget it. Life changes, income changes, expenses changes, your goals, your financial goals change. There are going to be points in your life which budget, honestly, first time you do a budget, it's probably going to take you 2 or 3 hours to get through everything. The next month that you do it, you might have it down to an hour, hour and a half. Once you get about 6 months into making a budget, it's going to take you like 15 or 20 minutes to review that thing, because the majority of the budget is fixed expenses. And checking this on really regularly when you have anything that changes. If you have an expense that changed, if you have a car payment, if you have insurance, if you get a raise, a promotion, that is the time to check in with your budget, really reflect on it, and see exactly how it is changing. Now, of course, when it comes to shopping, and we all love spending money, anytime that you're shopping for anything major, I want you to do 2 things. Number 1, shop around and compare. It is ultra competitive with everything that you have, from appliances to insurance. Comparison shopping can save you hundreds, if not thousands of dollars for the exact same insurance, exact same item, exact same coverage. Get at least 3 to 5 quotes before you commit to anything. And once you do review those quotes, give it 2 or 3 days of kind of a cool down period. Make sure you really need whatever you're going out and you're shopping for, and make sure that is going to be your best option. Now, of course, when we start doing this, being an educator and being a forever learner, never stop learning about money. There are so many things. Financial literacy is a lifelong journey. I teach this professionally, reading, listening to podcasts, watching YouTube videos, taking courses. And me even getting professionally certified for my financial planning, it really makes a big difference and allows you to give the tools to make a well-informed decision. Pass on the knowledge to your children. This is one of the biggest caveats when it comes to teaching your children about finances, making their financial journey much easier. And most people do not talk about it. They don't talk to family, they don't talk to friends, they don't talk, and most people, for anyone, they do not talk to anyone about finances, including me. If you want some advice or have some comments, questions, definitely drop them down below. And the next one we look at, be reluctant when it comes to co-signing. I work in a financial institution. I have for almost 20 years being responsible for someone else's loan, because if a bank does not qualify them for the loan on themselves, what makes you the ability or gives you the ability to go ahead and qualify the borrower, because the bank won't do it itself? This is a time when your credit can take a hit, your finances can take a hit, and you have to repay a loan. When you co-sign, you're 100% going to have to view this as you're the one paying for the loan. If the individual, the primary borrower, whatever it is, does not pay for this loan, you are fully responsible if this thing goes sideways down the road. You want to make sure and really ensure that you can cover the payment. You don't want to throw off your financial well-being just because you co-signed for your kids or a family member or anyone else. Now, of course, when we start looking at the financial picture, taking a step back, do not put off estate planning. This is really, and honestly, when you look at wills, when you look at power of attorneys, when you look at trusts, beneficiaries can prevent absolute disasters. I have seen individuals that did not have beneficiaries, and knowing where the assets go, unfortunately, if no one is on there, it goes to probate. Estate planning really protects your loved ones. Complicated, complex legal process that can be very difficult. And unfortunately, you're no longer here to worry about it, but go to your financial institution, go to your lending institution, go to your investments, make sure 100% that your beneficiaries are up to date. Again, that can be an absolute game changer. And the last one I'm going to leave you with, stay away from the get rich quick schemes. Making a fast buck is usually 99% of the time an absolute scam. Building wealth the proper way takes patience, discipline, steadily investing in the market. Scammers don't have any of those qualities. If you want to go in there, it is not so much about investing. It is not so much about building wealth. It is about getting rich quick. And how do you know better than them? How do you know? And the way that I see it is when you start looking at something that is too good to be true, chances are it probably is. In addition, if you're looking at these get rich quick schemes, chances are you're going to get burned, which I see a lot of people do, putting your money at risk. And at that point, I really do consider it gambling in its entirety. And again, the bonus one in here, pay attention to the inflation rates. The Fed has said they are coming down. So if you have any purchases coming up, even if you wait a month or two and the rates do come down a little bit, could save you hundreds, if not thousands of dollars based on the inflation rates and them lowering the inflation rates in the future. So making sure you're staying ahead of inflation, your money's earning more than it's losing year over year. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.